Spotlight Business Report, data-driven, fearless, fueled. I'm your host, Richard Anton. Tonight we examine one of the most devastating business collapses in American history, the rise and fall of Lehman Brothers. For more than 150 years, Lehman Brothers survived wars, depressions, and financial panics. It helped shape modern Wall Street and became a symbol of American financial power. But in September of 2008, the impossible happened. The fourth largest investment bank in the United States collapsed almost overnight. The bankruptcy triggered panic across the global economy, destroyed trillions of dollars in wealth, and helped ignite the worst financial crisis since the Great Depression. How did one of Wall Street's most respected institutions fail so catastrophically? And what lessons should investors, executives, and governments never forget? This is Spotlight Business Report. To understand the end, we must first go back to the beginning, the rise of a German immigrant dynasty. The story of Lehman Brothers began in 1844. Three brothers, Henry, Emmanuel, and Meyer Lehman, immigrated from Germany to the United States in search of opportunity. They opened a small general store, but they quickly noticed something important. Their customers often paid in cotton instead of cash. The Lehmans recognized that cotton itself had tremendous value. Soon, they transitioned into commodity trading, building relationships across the American South. As the United States industrialized, Lehman Brothers evolved with it. The company moved to New York and became deeply connected to the growth of Wall Street. Over the decades, Lehman financed railroads, manufacturing companies, airlines, retail giants, and eventually major corporations across America. The firm survived the Civil War. It survived the Panic of 1907. It survived the Great Depression. It seemed invincible. By the late 20th century, Lehman Brothers had become one of the most powerful investment banks in the world, representing prestige and influence. But beneath the success, Wall Street itself was changing, and those changes would eventually push Lehman Brothers toward disaster. In the 1990s and early 2000s, financial markets became increasingly aggressive. Banks discovered new ways to generate profits using complex products. One of the biggest opportunities came from housing. Mortgage lending exploded across the United States at unprecedented levels. Banks issued home loans even to borrowers with poor credit histories. These risky loans became known as subprime mortgages. Instead of holding the mortgages, investment banks bundled thousands of loans into financial securities and sold them to investors worldwide. As long as housing prices continued rising, everyone appeared to make money. Lehman Brothers became deeply involved in this booming market. Leverage became the key to higher profits. At times, Lehman was borrowing more than $30 for every single dollar it actually owned. That strategy created extraordinary profits during good times, but it also created extraordinary danger. They believed the market would remain stable. Few imagined that home prices could collapse simultaneously. But by 2007, the cracks were beginning to show. Housing prices began falling. As defaults surged, the securities tied to those mortgages suddenly lost value. Banks around the world faced enormous losses. Lehman was especially vulnerable. Its balance sheet was packed with risky real estate assets. Investors began losing confidence and the stock price collapsed. Credit markets tightened. Potential buyers backed away. In September 2008, government officials and executives desperately searched for a rescue deal, but none materialized. On September 15, 2008, Lehman Brothers filed for bankruptcy. The announcement shocked global markets and triggered a wave of panic. Investors panicked, stock markets plunged, and major financial institutions suddenly feared that no bank was safe. Credit froze globally. Businesses struggled to borrow, and consumers stopped spending. What began as a housing downturn had become a worldwide economic catastrophe. The collapse accelerated the Great Recession. Millions lost jobs, millions lost homes, and retirement accounts were devastated. The world was reeling. Governments worldwide launched emergency rescue programs. The United States approved massive bailouts to stabilize the banking system. Trust was broken. Executives faced intense criticism, and regulators were accused of failing to see the danger. Lawmakers responded with sweeping financial reforms. New regulations attempted to reduce risk-taking, but debate continues. Did governments do enough, or was the system itself built on dangerous assumptions? The story of Lehman Brothers is a warning about unchecked risk and the fragile nature of confidence. Within days, a 150-year-old giant vanished. In business, growth creates power, but when risk is ignored, even giants fall. Thank you for watching Spotlight Business Report. I'm Richard Anton. Data-driven, fearless, fueled. Subscribe for more deep dives into the decisions that changed the world economy forever. See you next time.